Hey folks, and welcome back to another video on my YouTube channel. In today's video, we will be going over the Ict Break-Away Gap. And the reason that I'm covering this topic today is because a viewer left a comment asking if I could do a video on it. So that is what we're going to do today. So a breakaway gap is, in very simple terms, just a fair value gap that doesn't get traded back into, or at least stays open, which means that price never filled it. Okay. And the breakaway gap is expected to form when, let's say we're bullish and you have identified a level that would be presented as support or a discount array, which basically just means a significant PD array and discount, or below the 50% Fibonacci zone level. That's discount. And the move that happens away from whatever PD array you established, that typically leaves behind a breakaway gap. It's going to make more sense the further we get into the video. So in simpler terms, a breakaway gap is just a fair value gap that stays open and forms near a swing high or swing low. And it's not used as an entry model, but used to determine the drawn liquidity or support the idea of price going lower or higher. So if we take a look at what I am looking at right now, this example that I'm showing you here is a chart on NQ, the 5th of June. And ICT used this very chart to explain the breakaway gap. So I'm going to do the same to get you as close to the real explanation or definition as possible. Okay. So remember when I talked about we had to identify a level that would be presented as support or a discount array. So in this case, we have what we call a BPR right here. If you don't know what a BPR is, I have a video on it. But it's basically just a bearish fair value gap that's overlapping with a bullish one, right? So right here, we have a bearish fair value gap and we have a bullish one. And we can draw a fair value gap inside of the two, which means that they overlap, okay? And that's all a BPR is. It's basically a more significant fair value gap. But that is essentially what we are going to use today as our discount array, or the level that is presented as support. More specifically, the equilibrium of that BPR, right? So as you can see right here, we have the BPR. But if we want to be more specific with price delivery, we take our Fibonacci, we find the 50% level of this BPR, and we draw it out. As you can see, it is very, very, very accurate. So this is our level that is presented as support because we are bullish. Had we been bearish, we had to find a level that would be presented as resistance, right? So, as I said, the breakaway gap forms after a hit on whatever level is presented as support. So as you can see, we come down into this equilibrium of the BPR, and then the move in the opposite direction of the BPR. So this entire move right here is where we would look for our breakaway gap. And as you can see right here, we have our breakaway gap. Maybe a bit too thick now when I think about it. There we go. Okay, so that's our breakaway gap. Okay, as you can see, price did not trace back into it, and it certainly did not close it. If you don't know what it means to close a fair value gap, let's say the wick of this candle had done that, that would have closed the fair value gap, right? Or filled it, or whatever term you want to use, right? So because this fair value gap stays open and never gets traded back into, that is a breakaway gap. And this is something that you want to see if you were long in here. Let's say that I went long off the 50% level of the BPR, right? Then this is exactly what I would want to see to support my bullish idea. Let's say I have my take profit here. And as soon as I see us create this fair value gap, I want to see price immediately trade away from it very aggressively, because then that makes this a breakaway gap. And that is what you want to see when you're, in this case, bullish, right? So it is actually very, very simple. It's just something that supports your, in this case, bullish idea. it's something that you want to see when you're in a long position, in this example, right? So it's not an entry model, it's not none of that. It's just a fair value gap that does not get traded back into. So if I was in this trade and I was a bit confused on whether price wanted to take out this high or this high or this high, right? Then I could tell myself, okay, let's I'm gonna try and hold to this high, but for that to happen, for me to stay in the trade, I need to see this fair value gap stay open. Okay, if this fair value gap gets closed, I'm gonna close my trade. That is how you could utilize the breakaway gap. So not as an entry model, but rather as a rule or just something to support whatever idea that you have, right? So that is really what it is. It's a fairly simple concept. So I hope you understood. It's basically a fair value gap that doesn't get traded back into. And I assume it's called a breakaway gap because it is the gap that forms when price is breaking away from a certain level aggressively. Just like in this example, we are breaking away aggressively from the discount array that in this case was a BPR, right? That is basically all it is. So I hope you understood. And if you didn't, don't hesitate to tell me in the comments what you were having trouble understanding, and I'll try my best to help you out, okay? My DMs are always open on Twitter too, so you could go on Twitter and DM me for any questions. And as always, I appreciate you guys interacting on my YouTube channel recently and supporting my content. It's been great. So I'm very, very glad that people are finding the stuff I post useful. That's why I post it. So yeah, thank you a lot and stay blessed. Bye bye.